Finance. Hello and welcome back to Insane Finance. Today we're going to go over one of my favorite stock terms. This is BVPS, or book value per share. And book value per share, when I first started studying this term, it was really confusing. And I'm going to go through my process of what I looked up and the definitions that I saw when I first started trying to figure out what book value per share was and why it was so confusing, and take you through the same process so that you can discover what I discovered and know this term just as thoroughly as I know it, which I am not an expert, and none of this is financial advice. I am just a regular working class guy, dirty hands, made all my money with blood, sweat, and tears, and then invested in the market. And I turned out to be pretty good at investing. So if you're just a regular person that wants to learn a little bit about investing, and you're not sure because you've listened to other experts and they talk in what seems to be hieroglyphics, then you're at the right channel, because I speak in layman's terms. And when I can't speak in layman's terms, it's because there is no layman terms for what I'm trying to talk about. And I try to explain as best as I can these terms. Now, book value per share. First thing you're going to find if you do a Google search on what book value per share is, and listen to this and tell me if it doesn't sound like Greek or something. Book value per share, BVPS, is the ratio of equity available to common shareholders divided by the number of outstanding shares. This figure represents the minimum value of a company's equity and measures the book value of a firm on a per share basis. What? What the hell? That's their definition. So if you don't know nothing about stocks and they hit you with that, what are you going to do with it? But the fact is, as you'll see as we go through this, book value per share is actually a shortcut to telling you something you really need to know about stocks before you decide whether you want to waste your time doing a bunch more research on that stock, or if you just want to throw it aside and move on to another stock. Bear with me here, and believe me, you'll be glad you listened to the rest of this. Unless you already know what BVPS is, and I don't know why you clicked on this if you do. But I'm glad you did, and I appreciate you being here, wasting your valuable time watching my video. First thing we need to know is what this equity term is, because the rest of these terms, as you'll see, you can pretty much just throw away. We'll come back to this, and I'll explain it after we go over share equity, because you're not going to understand any of it if you don't understand share equity. Okay, so a quick Google search of share equity will come up with some other Greek speak or hieroglyphics, like shareholders' equity may be calculated by subtracting its total liabilities from its total assets, both of which are itemized on the company's balance sheet. Total assets can be categorized as either current or non-current assets. Wow, if your brain hurts, you're not alone. Okay, in layman's terms, what they're trying to say is, say, you're a teen. Let's not even think about companies right now, because it's just a little bit too complicated with companies. And let's say you can do the same thing with when you're a teenager. You got $2 in your pocket. You got no credit cards. You got nothing. But somehow you're better off than most 20-somethings, because you got $2 in your pocket. You don't own hardly anything. Maybe you own your motorcycle, and your motorcycle's worth $1,000. And you don't have any credit cards. You don't have any debts. So the $1,000 motorcycle plus the $2 in your pocket is $1,002, and you got no debts. So don't subtract anything from that. You got $1,002 of equity. Then you're 20-something, and it gets a little bit more complicated, because now you got a car, and it might be worth $3,000. You got $20 in your pocket, but you got $4,000 of credit card debt. So normally you would subtract that credit card debt from the stuff that you own and the money that you have in your pocket, and you might have another $100 in the bank, but you would have that $3,000 car, $100 in the bank, $20 in your pocket. That's $3,120. You got $4,000 credit card debt, and so you have a negative what, $880 of equity. So you have a negative equity. Flash forward to like 35 years old, and you've got a $200,000 house. You got some cars, but you owe $100,000 on the house. You got $13,000 in credit card debt, but you got $20,000 in the bank. You see where I'm going with this? You add up everything that you own, and you add up everything that you owe, and you subtract what you owe from what you own, and then you have a number there that's your equity. Well, you do the same thing with these companies, only it's more complicated because they own more stuff and they have more debts. And we're not talking about the debt that they have in the share price. That's a totally different thing. We're talking about non-shares, just the same kind of debts that you and I would have that owe this, that owe that. Okay, they might be paying on this building, paying on that building. They might have this piece of equipment. In my last business, I had like $100,000 worth of equipment. Luckily, I bought 2 or 3 pieces of equipment at a time as my business was growing. So I never had more than $20,000 or $30,000 of debt in equipment. But I didn't always have $100,000 worth of equipment. So I started out pretty much in debt on the first 2 pieces of equipment. But that's a whole nother story. We'll get into that later. You know what equity means now. So now that you know what equity means, let's go back to this book value definition, book value per share definition, and let's pick it apart further. Again, the way they've got it written, book value per share, BVPS, is the ratio of equity available to common shareholders divided by the number of outstanding shares. This figure represents the minimum value of the company's equity and measures the book value of a firm on a per share basis. Now, it doesn't need to be that complicated. Number one, you could just say the equity divided by the number of outstanding shares equals the book value. So see how much simpler that sounds? Equity divided by the number of outstanding shares. So let's say the equity of the company, and I know no company that's got shares is going to be this low, but just for the sake of making it easy, the equity of a company is $10,000. And they have 1,000 shares outstanding. And I know that number's too low too. So if you want to get technical, you could just add 6 zeros on the end of both of those numbers and go hurt your brain. Let's just keep this easy and simple. 10,000 of equity, 1,000 shares. What does that give you? It gives you $10 per share. But what if that company only had 1,000 shares? No, I'm sorry. What if that company only had 100 shares? That would give you $10,000 of equity, $100 per share instead of $10 per share. So you can see that this gives you a really quick cheat code that you don't have to calculate equity of a company your own. You don't have to find out how much that company owns. You don't have to find out how much that company owes and then do all those calculations yourself. And you don't even have to find out how many shares are outstanding in that company. There's 3 metrics of the company that you don't have to go finding out. if you use the book value per share as a metric in your decision-making process on whether to really seriously think about buying shares in a company or not. Because the book value per share utilizes all three of those metrics in a way that gives you a deeper understanding of the health of that company and a deeper understanding of the value of that stock. And of course, you got to know the price of the per share of the stock, but if you don't know how to look that up, I don't know how to help you. And it would be a whole nother video. So I hope you like this deep dive on the book value per share, or the BVPS. And if you want to see more of my breakdowns of terminology for stocks, layman's term breakdowns for terminology for stocks from the perspective of a not professional investor, an amateur investor, if that's the kind of thing you like, then please keep coming back, maybe even subscribe. If you know somebody that you think could benefit from this explanation, then of course share this video. But above all, let me know in the comments what you think and what you want to know about. What kind of, if you want to hear some more definitions, and what terms do you want to see defined? Till the next video, I'm wishing all my insane friends insane growth and an insane amount of success.